Welcome to the Deep Dive, where we tear into the dense market data and distill the absolute critical insights for you. Today, we are strapping in for a pretty wild ride into the consumer cyclical world, specifically the gambling sector.
It's more than just volatile right now, it's seismic. I mean, our data snapshot from January 14th was just screaming. We saw massive trading volume, price action that, for some of these names, just completely defies gravity.
And it's not just about random betting. This is about a huge tectonic shift, right? It's being driven by one key subsector, prediction markets.
Exactly. That's the gold rush.
So our mission today is to give you that journalistic, technical, and fundamental breakdown of the three stocks that really define this moment. We're going to unpack high roller technologies, that's ROLR, then lottery.com, SEGG, and of course the big one, DraftKings, DKNG.
Yep. We'll look at their financial health, the technical triggers, the news that lit the fuse, and we'll even run some paper money math. Show you what could have been won and lost in all this chaos.
Okay, let's just dive right in. We have to start with the main catalyst, the stock that just went vertical, High Roller Technologies, ticker ROLR. I'm looking at the report here. A 436.65% change on one day. Was this something building up or just a layering strike?
Oh, it was a lightning strike, pure and simple, fueled by raw anticipation. ROLR is a small cap, only about $160 million market cap, trading around $18.89. But the valuation tells you everything you need to know about the speculation here. The price to book, the PB, is 24.33.
Wait, hold on. 24? I mean, a normal stable company might have a PB of 2, maybe 3. What does a number like 24 actually mean for our listeners?
It means investors are betting on an idea. They're saying the company's future potential is worth over 24 times more than its actual physical on-the-books assets. It's a valuation based almost entirely on hope and a signature on a new document. The price to sales of 5.72 backs that up. It's high for an unprofitable company.
And here's another thing that jumped out at me, a huge risk factor. Insider ownership is at 75%. With a stock this volatile, doesn't that make the risk of a massive insider sell-off just dangerously high? Especially now that it's way above the $8 target price.
It absolutely raises a red flag. When insiders hold 75%, the public float of shares is tiny. That means good news sends it flying, like we saw. But any big sell-off will hit it just as hard on the way down.
So what was the good news? What was the ignition switch?
It was huge. On January 14th, High Roller signed a binding letter of intent with Crypto.com Derivatives North America. It's an exclusive partnership to launch event-based prediction markets in the U.S. This is the new frontier everyone is chasing. That, plus a strategic investment from Saratoga Casino just a few days before, and boom, liftoff.
Okay, so let's ground this in reality for a second and look at the actual financial health. Sales are pretty modest, $28 million, but their margins, I mean, they're just bleeding money.
They are fundamentally unprofitable. That's the key. Operating margin is negative 18.58%. Return on equity is a deeply negative 78%. And while, yes, the EPS quarter over quarter had this huge eye-popping swing of 735%, it's coming from a very, very low base. And before we go any further, we should be perfectly clear here. We are discussing public data and hypothetical modeling for educational purposes only. This is not in any way investment advice.
Right. A very crucial point. Thank you. Now, let's talk technicals, because this is where it gets even crazier. The volatility is confirmed by a beta of 3.22. The performance for the week was over 600%. It's a vertical chart.
But that volatility cuts both ways. And the most crucial signal for you to see here is the RSI, the Relative Strength Index. The RSI 14 is sitting at 96.52.
96. And anything over 70 is already considered overbought.
Exactly. At 96, ROLR is basically hitting the statistical ceiling of 100. It doesn't mean it has to drop tomorrow. But the risk-reward calculation has completely flipped. You are quite literally betting against financial gravity at that point.
So let's quantify that win. Let's play some paper money math. What did that catalyst mean for, say, a hypothetical $5,000 position?
Okay, so the scenario is you buy RLR at the previous day's close. That was $3.52 right before the news hit.
$5,000 would get you about 1,420 shares.
Correct. And if you sold those 4,420 shares at the peak price of $18.89, your position is now worth $26,823.80.
Which is a paper profit of $21,823.80. That is the 436% return, all driven by a single letter of intent. Incredible.
A phenomenal reward for taking on what that RSI tells us is just enormous risk.
Okay, so from the catalyst, we move to the ripple effect. Lottery.com, ticker SEGG.
Right, SEGG. It saw a nearly 80% surge on the exact same day. This was a classic sector sympathy rally.
Hmm.
ROLR's news was so powerful it basically lifted all the other small boats in the sector, and SEGG was one of them.
And SEGG is a true microcap. We're talking a market cap under $5 million, trading for less than a buck. The valuation here is just bizarre. A price to book of 0.12, so its assets are worth more than the stock price. But the analyst target price is 15.50. That is a massive gap. It just screams either deep undervaluation or deep skepticism.
The story here is a Hail Mary pivot. The company is desperately trying to rebrand as SEGG Media, focusing on global sports and entertainment. And for a company this tiny, they are making some audacious moves, acquiring a majority stake in Ant Media, trying to buy Tricky.ai. And the biggest one, a $300 million Web3 initiative to tokenize sports and entertainment. That's a huge ambition when your market cap is less than $5 million.
Those are absolute swings for the fences, but the financials, they paint a pretty brutal picture of why this company is in such a tough spot.
They absolutely do. Sales are almost non-existent at just under $1 million. And the negative margin figures are shocking. We're talking a gross margin of negative 776% and an operating margin of negative 666%.
Okay, wait, let's simplify that. An operating margin of negative 1,600%. Does that mean they're losing about $16 for every $1 of revenue they bring in?
Precisely. This isn't just a company in distress. This is a company in survival mode, funded entirely by investor belief in this pivot. Liquidity is also weak. The quick ratio is 0.63. A number below 1 there suggests they could have trouble covering their immediate bills. They need this pivot to work, and fast.
That context makes the rally even more fascinating. Technically, the relative volume confirms it was all external interest, over 1,900 times the normal trading volume. And even though the stock is down 79% for the year, the short-term momentum was undeniable.
And that momentum gave traders a very clear signal. The price jumped 21% above its 20-day simple moving average, the SMA 20. For momentum traders chasing that sector rally, that decisive cross was a powerful short-term buy trigger.
So let's see what that ripple effect meant for a paper money investor who caught that wave.
Hypothetically, if you put $5,000 into SEGG at the previous day's close of 52 cents, you would have picked up approximately 9,615 shares.
And at the current price of around 92 cents, those shares are now worth $8,903.96.
Which is a paper profit of $3,903.96. So almost an 80% daily return. A huge short-term win, but one that was entirely dependent on ROLR's news, not its own.
So we've got ROLR priced on pure hope. We've got SEGG running a Hail Mary pivot on a ripple effect. Now let's swing to the anchor of the industry, DraftKings, DKNG. How does the established giant react when all these little microcaps start flying?
DKNG is playing a completely different game. They are the industry giant, $30 billion market cap. While their PS ratio is actually similar to ROLR's, around 5.6, their forward PE of almost 52 tells the real story. The market is pricing in future dominance. They're highly valued, but for a reason.
And that reason is scale and the path to profitability, right?
Yeah.
Sales are huge, $5.46 billion. They're still not profitable, but their sales growth is consistent, over 18%.
That's it. The market expects a rapid conversion to profitability. Earnings per share for next year is projected to grow a staggering 426%. That's why you pay a forward PE over 50. You're paying for that explosive growth to come. They're also using leverage aggressively to finance it all.
And what's fascinating here is that they are not sitting back and watching. They're strategically defending their moat. They've already launched their own prediction markets app, which news reports say actively blurs the line between betting and trading.
It's a necessary defensive move. They can't afford to be left behind if prediction markets become the new high-margin product. We also see some mixed signals internally. Lots of insider sales from executives in 2025, which can be normal, but the volume is worth noting. But that contrasts with 2 notable director buys in November, suggesting some high-level faith in the long-term plan.
The technicals are just a world away from the microcaps. Volatility is comparatively low, a beta of 1.67. That stability compared to RLR's 3.22, that really defines the moat they've built. The RSI is completely neutral at 48.
Exactly. They are trading below their long-term average, the SMA 200, by almost 9%. So to define the trading signals right now, the price is just below the short-term SMA 20. A strong move above that line, around 34.77, would be a short-term buy trigger. On the other hand, a drop below the SMA 50, which is around 32.95, would likely be seen as a sell trigger if this recent weakness continues.
All right, time for the paper money math on the giant. While ROLR and SEGG were having their moment, how did DKNG actually do during this chaos?
Well, their performance over the week was actually a slight drop of about 1%. So let's say you bought a week ago. The price then was roughly $34.66. A $5,000 investment would have gotten you about 144 shares,
And with the current price down at 34, 32, those 144 shares are now worth $4,942.08.
which results in a paper loss of $57.92, a negative 1% return. So while the microcaps were soaring on pure speculation, the stable giant was just drifting. It really reinforces the theme that this volatility is all about the future, not current business health.
So what's the takeaway here for you, the listener? We've just seen three radically different stories in the same sector. You've got the anchor, DKNG, leveraging its massive scale and defending its turf. Then you have these hyper-volatile microcaps like ROLR and SEGG just chasing a dream.
The main takeaway is that the entire sector, for now, is defined by this race for prediction markets. It is fueling extreme volatility, and it's turning tiny companies into momentary titans based on little more than a press release. It's speculative, but it's fundamentally changing how the market sees this space.
And if we connect this to the bigger picture, the news is constantly talking about this blurring line between betting and trading. So here's the provocative thought we want to leave you with. If this prediction market trend continues its regulatory and market expansion, what happens to the core business of traditional sports betting? Will this new high-flying subsector become the dominant source of revenue, or will it just end up cannibalizing their own customer base, leaving everyone fighting for scraps?